Welcome back to Morning Markets from the team at True Potential. Today we'll look back at asset market performance from yesterday and what was a relatively subdued asset market performance across both equities, bonds and currencies yesterday. Little real differentiation to be seen there. If we just take a little bit of a step back and maybe look into some of the sector performances yesterday, very much just a continuation of the theme that we touched on yesterday, with the growth areas of the market continuing to have a little bit of outperformance relative to those areas that have been very strong and positive over recent months, that have been associated with the reopening of economies. So those sectors that are more cyclically or economically exposed, such as energy, financials, industrials, travel, leisure sectors, all that have been on a strong performance of late, slightly weaker over the past couple of days. And that all ties back into what we've been discussing around the sovereign bond markets and how interest rate expectations and inflation expectations have evolved over the past number of weeks. What we've seen over the first couple of days of this week is a bit of stability in sovereign bond markets in particular. So not that same directional movement that we have been seeing with yields moving out. That has kind of not occurred over the first couple of days of the week anyway. And we'll see really what today holds, because today will be a very crucial day in that regard, given that we have the Federal Reserve meeting after UK and European markets close. So we'll get their announcement 7:15, I believe, UK time. And that will be important for a number of reasons. And I'll come on and discuss that in a moment or two. Just then digging into some of the other points from yesterday, really focusing in on the comments or two from Europe. We had the European Union leaders meeting, and really that concluded with a very similar theme to which we've been hearing from the ECB as well, and really the need to keep a supportive budgetary stance through 2021 and also into 2022. So just indicating the challenges there. And as we saw yesterday, we saw that with the slow pace of the vaccination rollout in Europe. So something that is very much front and centre there. The other thing I just wanted to touch on from yesterday relates to sovereign bonds, relates to the US Treasury market in particular. One of the things that did cause the weakness in Treasury bonds a couple of weeks ago was really a disappointing Treasury auction. We commented last week that we'd seen 3 auctions that were well received, and indeed yesterday we did an auction at the 20-year level for some $24 billion, and that again was well received, and we didn't see much indigestion, if you will, as the market took that auction on board. The other thing that probably helped stabilise and give pause for thought around the direction of inflation and sovereign bond yields was just retail sales in the US yesterday, and they came in at a relatively disappointing level, falling 3% month on month. Expectations had really been for a much more marginal decline, something in the region of 0.5% month on month. So quite a bit of a divergence there. There are a number of factors that I think probably did weigh on retail activity in the US in the month. If we look back and we think about the very bad weather that we saw, the impact that had on a number of states. Look at Texas, really impacted oil production quite significantly, caused a number of issues from an electricity perspective. So really the ability to go out and spend money wasn't there in a number of states. But I think the other thing to think about is just the role that the stimulus payments have been playing in supporting that strength in retail sales. Really coming through then, it was waning off. What we're getting now is we know that the $1,400 payments have been made over the coming weeks and months. Indeed, we will possibly see that coming through into the retail activity in the US. So certainly a point to watch and just see how it evolves. It was worth noting that the fall month on month was really exacerbated by quite a significant positive revision to the previous month. So retail sales for January revised up from some 5.6% to 7.3%. So really that strength very much concentrated in January, and then that drop off into February. I think also yesterday I just wanted to touch on the Bank of America monthly fund manager survey. Gives an indication really of how market participants are thinking about risks, how they've positioned portfolios, etc. And just interesting to note that a bit of a change in the biggest risks as they're viewed for the market. Past 12 months, the main risk that has been front and centre of everyone's mind has been COVID-19. Just worth noting that from a market perspective, that has changed. It's now the third risk that fund managers are identifying. The first is really around inflation expectations and how that is evolving. And the second is, I suppose, a direct relation of that in that concern about how the bond market might perform as well. So really a bit of a change in market sentiment, but then that also speaks to really what we've been discussing and the influence of sovereign bond markets on asset prices, be that in the dollar and be that on equity markets as well. So we can really see that coming through. Just looking to the day ahead, as I've touched on, very much a focus on the Federal Reserve meeting this evening, both in terms of what's said at the press conference, but equally importantly will be their set of economic projections that they provide. And within that, they'll discuss something called a dot plot. And what does that? It gives us an indication of how the voting members are thinking about interest rates on a forward year basis. And this time we'll get it revised forward a further year until the end of 2024. This is a useful guide because clearly when we had the last set of projections from the Fed, it was at the end of December. We had only one of the voting members expecting any change in interest rates to the end of 2022. And even then, it was a marginal increase. What will be interesting to see tonight is how that evolves and how their thinking about forward interest rates have evolved, given the dynamics have changed. What have we seen? We've seen further fiscal support packages coming through. We've also seen a stronger uptake and rollout of vaccinations in the US, things that do point to a stronger economic environment and hence a situation where interest rates may need to rise at some point into the future. And we'll get an indication of the thoughts of the Fed members. And it's really interesting then to contrast that with market expectations. Market expectations at this point have moved ahead of the Fed. I'll leave it there for today, but please do join us again tomorrow when we'll look back on the Fed's meeting and how that dot plot has evolved. Thank you.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.